Hi, I'm Stephen Murray from Pan-African Capital Group. I'm their Senior Investment Officer making investments across Africa. Thank you for watching AFK Insider. The most rewarding aspect of my job is working with African entrepreneurs, African managers, African business people to help grow these companies. I love traveling to Africa. I love rolling my sleeves up and working side by side with management and helping to grow these businesses, create new products, create new service delivery models. And that's, to me, what's most exciting and most fulfilling about my job. DataBank is an asset management company. It was established over 20 years ago by Ghanaians who were living and working here in New York and Washington, D.C. They'd been educated here in America. They were working on Wall Street. They were lawyers. They were bankers. They were insurance brokers. And they said, look, here's an opportunity to go back to Ghana and build a company from scratch. And they did that, and they were kind of on the first wave of the returning diaspora. And they built an asset management company that is really unique. What they're doing now is they're kind of extending into different asset classes. And the most exciting thing they've been doing is they've been managing an agriculture fund that's focused on SME type investments. So they're looking at making smaller investments into opportunities that are either adding value-added manufacturing at a farm gate, maybe a product extension, or maybe just yield improvements for agribusiness companies across Africa. And that's very exciting because that's a critical need in Africa. Our company, Black Rhino, which we recently invested in, is an infrastructure development company. And they are building catalytic infrastructure projects across the continent, working on oil refineries, power plants, railroad concessions, working on building the kind of infrastructure that Africa needs. The key there is that they're taking a very Western approach. They know exactly what the investors need to invest in these types of projects, the type of returns they need, the type of structure they need, the type of risk mitigation that they need. So they're building these projects with that in mind. And that's exciting because it's going to allow them to do these projects more quickly and more cost effectively. In terms of the return expectations for Africa, people are actually wanting higher returns in Africa because of the perception that it's a greater risk. For investors in Europe or North America, if they were expecting maybe 10% return on investment, in an African context, they would probably be expecting 20 to 25% return on that investment. And realistically, those return expectations are coming down as Africa becomes less risky, but I don't think they're going to come down to the point where African projects that offer just a 10% internal rate of return are going to be attractive to most investors, at least private sector investors. But what's important for Africa is that there's not just private sector investors, there's also public sector investors, NGOs, bilateral governments, who are investing in some of these projects that may not meet the return expectations of private investors, but do meet the objectives of the Africans in terms of maybe it's building infrastructure, maybe it's providing health care. So there are a lot of actors at play in Africa, and thankfully not everything has to be done by the private sector. There's a lot of public sector funds that are out there doing really important work and improving the lives of Africans in general. It is difficult for the SME sides. For most investment firms, the cost of making an investment are very similar if that investment's $1 million, $10 million, or $100 million. So obviously, if the cost of making that investment is similar in terms of the amount of due diligence we have to do and the amount of resources we have to deploy in order to make sure this investment is something we want to do, then it makes sense for us to do bigger investments, to spread that overhead cost over a larger investment base. So it is challenging for SMEs. However, there are a number of specialized funds that are doing this. And the key for these specialized funds is that they're on the ground. So they're not being managed by people sitting in London or Washington, D.C. or New York or Paris. They're being managed by people who are on the ground in the continent. That cuts the cost of due diligence down significantly and the cost of managing these companies significantly. And so you're starting to see them make smaller investments. DataBank's a great example. We couldn't manage that DataBank fund from Washington, D.C. or New York. They can manage it from Accra and Johannesburg, because they're on the continent already, and so their costs of doing business are much lower than ours would be.